Good afternoon, everyone. This is Mike Flaherty with AlphaCentric, and I'm joined today with Brian Liu. Brian is the co-portfolio manager for our Income Opportunities Fund. Brian, good afternoon.
Hey, Mike, always good to see you.
Good to see you too. And, Brian, we try to keep these calls contextual. And, late you've heard Jamie Dimon talking about the cockroaches out there in private credit and how so many of these companies have lent money to software companies. And then you pick up the Wall Street Journal yesterday and you read about Blackstone private fund hit by exits. You read about Blue Owl, who's a big BDC, and how they're putting the gates up. And at the same time, there's this movement afoot to have these type of vehicles in 401ks. And so, it seems like, there's sort of conflicting messages there. But talk talk about talk about kind of what you see as a credit guy in this whole private credit space. And then when we do that, that let's contrast that to kind of the fundamentals. And I know people probably get tired of it, but I mean, the fundamentals are the fundamentals in this whole legacy non-agency space. So, Brian, the floor is yours, my friend.
Yeah, and I'm certainly biased, for structured product versus something like more credit or company corporate credit based products. I think if you look at the last several years where we've had mortgage rates much higher, and that has really dried up origination on the mortgage side because people haven't been buying homes or just transacting as much. That's made our space shrink, and it's also made it kind of less attractive for people to try and get involved into the space because of just the lack of issuance or the lack of guidance from things like new issue. And that
Mhm.
also too has kind of, on the flip side, I guess it's made people say things or look at things in private credit and start saying, if I can't get the yields that I need in this space because it's shrinking, or it's because I can't get the targets that I need to, or get higher yields than I need to, where can I go? And so they start going to private credit. There's a big bunch of issuers out there who are saying, yeah, oh yeah, I'll happily borrow the money that you're offering me, because they need loans to go into CLOs, or they want to put them into private credit vehicles. They want to try and get financing for or private equity situations. I think with AI and things that were developing in that space, everyone was really anxious to get exposure, to get involved, to get these companies moving. And so in some ways, with the I don't know if I call it free money, but at least the abundance of money available, a lot of industries and a lot of lending occurred. A lot of industries got money that maybe was a little bit premature, or maybe even less due diligence went in, because people had to compete with each other to try and get these loans on their books, or be able to make the loans to get on their books. And so a lot of the situations that you've been seeing in headlines have been revolving around double pledged collateral, right? Or situations where banks were all lined up, and they're pretty prominent names, pretty prominent banks,
Uh-huh.
and they're going to end up getting hurt by these situations because the collateral wasn't as perfected as they thought, or it was again double pledged, or it wasn't as well tracked. And that's usually something that happens. If you think back to the GFC and kind of those other times where lending got haywire, is because of kind of this over anxiousness of people to be willing to put the money out so that they could get that loan on their books. And so I think we're seeing a lot of that come to a head. There have been some very prominent names in that space who are saying this is going to be a little painful for a while, and we're going to see how things shake out in the next 18, 24 months. And I'll take the next part of your question, which is my positive bias, right? I mean, I definitely think in structured products, in particular in non-agency RMBS, or where we like this mortgage product, we in particular like seasoned subprime mezz, right? And that's stuff that's already gone through the fire of the GFC. By now, these borrowers have been in their homes for going on 20 years. Right. So if there are any collateral issues, or if there had been any kind of fraud and all that kind of stuff, most of it got washed out in the GFC, and certainly if not, then in the 10, 15 years hence, right, or since. And so we like how that collateral now has very delevered, right, or is very delevered. You're talking about LTVs on the order of 30 or 40%, and that borrower's made those payments for this long now. We think that that provides a great backdrop, and then you have to look at structure and see how that very seasoned collateral can help in the structure.
So LTV of 30 to 40, layman's terms, that's equity of 60 to 70.
That's exactly right. And
60
so
to 70
60
sports
to
fans.
70 for a borrower who has been in that home, or been making payments on that home for this long. It's almost like it's part of their life, and they've survived that time. So we look at that as very positively selected collateral pool also.
Have there been any things that have come across the airwaves here over the last few days that kind of have gotten your attention in this space?
Well, I was just mentioning earlier about how non-agency RMBS issuance had shrunk, right? And certainly this administration and many people have been talking about home financing and how they can improve that, and whether Fannie and Freddie can lower rates and all this other stuff. Um, Another a pretty big name in non-agency space came out just within the last couple of days and was talking about how the size of the market should be growing again. I definitely think that there was, and I forgot the name of it offhand, but there's kind of public opinion being sought on whether issuance can, instead of being all 144A, some of it can be more public, right? And that's going to help the registration a little bit. That probably doesn't affect as many of the investors in a lot of these non-agency space, but I think it could have some impact. And the fact that it could just be more of an emphasis again, I think that will expand mortgage financing. I think.
It's terrific. So, we're talking about a space right now where the average price of the bonds, the legacy bonds, is kind of high 70s, low 80s.
Yeah, give or take. I mean, we can certainly find a full range, but that's kind of where we like to be.
So high 70s, low 80s was something that's got 60 to 70% equity, and probably has another what, dozen years until these things mature, give or take.
Yeah, give or take, right? And so I think if you look at that, you have this nice aspect of price convexity because you're kind of pulling towards par. A lot of the bonds, as we've talked about in other times, have this right back feature where you can, recapture prior losses with excess spread, and excess spread has been increasing because front end rates are dropping, and so there's actually some potential in some of these situations to get more than par. And so I think there's a lot of upside that's kind of turning back on after several years of high rates. As we kind of get back into this lower rate scenario, I think that a lot of these options are going to be a lot more valuable.
And we're still talking about a high 7, low 8 handle yield as well.
Yeah, yeah, and so you're, in that sense, you're getting paid even if rates are to kind of stay at this trajectory or stay at these broad levels, right? Which we think a lot of the rate cuts that we've seen the last couple year ends are really starting to come through on a lot of the bonds to impact them positively with this excess spread aspect. So we still think it's going to be a lot more upside from here.
All right, that's terrific. So, Brian, let's leave it there for now. Thanks so much. I've got a couple of things that I'd like to see play out here over the next few weeks that we'll connect with you on here as we move into April. But until then, thanks for joining us, and thank you, friends, for joining us on the call today. We'll look forward to talking with you again. Bye now.